Hello, welcome to Natural Gas World's weekly review of the news in the global gas industry with me, Joseph Murphy. So first today, we're going to have a look at what the majors are up to over the last week. So BP has said it will book up to $17.5 billion in write-downs on its assets in the second quarter after cutting its price forecast for oil and gas in the long term. So why has it done this? Because it's taking into account the economic slowdown as a result of the coronavirus, but it's also expecting oil and gas demand to be lower in over the coming decades because of the energy transition picking up pace. So the company now expects oil to average $55 per barrel between now and 2050. It also sees gas prices, Henry Hub gas prices at $2.9 per million BTU. So this is a pretty bearish outlook. So these impairments it's going to book, I mean, they're non-cash charges, but they're still significant in terms of increasing BP's gearing. Debt's a key concern for the company, so its net debt rose by about $6 billion over the first quarter. BP has said, of course, recently it's going to cut 10,000 staff from its global workforce. That's about 15% of the total. It's made a big cut in capex by about a quarter. And with these write-downs now on the horizon, the next question is whether BP will cut its dividend. So if it did that, it would really be breaking rank with the majors, most of the majors anyway. Shell cut its dividend by 2/3 last year, of course, but the rest have maintained them. As for the other majors, there's been more news of divestments this week. So Exxon Mobil has said it's resuming its sale of its UK North Sea business. That includes stakes in about 40 fields. So it wanted to get rid of these assets earlier, but market volatility got in the way. It sold its Norwegian business last year to Vår Energi for, I think it was $4.5 billion. It's exiting Europe altogether, actually, to focus on big projects in the Americas, off Africa. Another key sale we've been watching is Exxon's stake in the Neptune Deep gas project off Romania. So it confirmed this sale last year. No movement so far, but it's something we're keeping an eye on. Meanwhile, Shell is looking to divest 2 fields off Norway and some pipelines. These fields are relatively small, past their peak in terms of production, so not a huge sale, but something to keep an eye on. So with these divestments, it'll be interesting to see which buyers step forward. So after the 2014 oil price crash, you had a lot of private equity firms entering the sector and swiping up assets very cheaply. The same might happen this time round. The key thing is a lot of the established players in the North Sea, they don't have a lot of cash to fund big investments right now, expansions. So what you're likely to see is a lot of companies coming in which maybe don't have that much present exposure to oil and gas prices. So they've got the ability to take advantage of the current market to get good purchases. Outside of the North Sea, going to Australia, Chevron has said it's looking to sell its stake in the Northwest Shelf LNG project. Now, this is Australia's first ever LNG project. Why is Chevron doing this now? The fields that supply the project are now running out of gas, or at least they will do in the next few years. So to keep the capacity at full, the project's going to have to rely on a lot of third-party gas. Chevron doesn't want this, so it's decided now's the time to call it quits. And again, divesting this project will help with its cash needs. Sticking with LNG in Croatia, there's been some good news for the Croatian LNG import project. So it's now managed to get reservations for almost all its capacity of around 2.6 BCM per year. This comes after a major booking by a Qatari firm called Power Globe for 15 years of capacity reserved. And this is really good news for the project because there were some doubts about whether it would get enough commercial usage to turn a profit. Earlier this month, before the Qatari booking, it also got some reservations from Croatian, Hungarian buyers. And yeah, what this really tells us is there is a sufficient gas market in Southeast Europe for new import capacity. So these have been the key stories from this week in the global gas industry. This has been Natural Gas World's weekly review with me, Joseph Murphy. Thanks for checking in and see you next week.